Friends, greetings to you. Welcome to this very special Robinson Report video version. Today is Sunday, the 24th of March. We have several things to cover, so let's just dive right in. Of course, as you know, you always want to make sure that you remember our disclaimer as you're looking at our materials, whether it's a video or any of our documents that we put out. Remember, you always want to do your own due diligence, always double check and re-verify data. It's just important no matter who you're reading, whether it's some major newspaper or even Follow the Money. You always want to double check what we have put together. We make mistakes, and so you should always do your own due diligence. Okay, so let's go ahead and dive in here. We see, first of all, the very first thing we want you to see here is that the yield curve has finally inverted. I mean, we have had so many times this has come close, and we've heard that different treasuries had inverted, but this is the biggie. This is the 3-month treasury, or I'm sorry, the 3-month T-bill and the 10-year treasury finally inverting. And so that's a real big deal. When the 10-year treasury yield actually dips below the 3-month treasury bill yield, that's known as an inverted yield curve. And when that happens, in fact, over the last 7 recessions that we have had, this event has preceded it. Now, it doesn't necessarily mean that we're going to see the recession begin immediately. It doesn't even necessarily mean that we're already in a recession, according to this indicator. But typically, what we see is sometime between 3 months, it may take a couple of months, all the way out to 24 months sometimes, for the recession to actually show up in the data, in the official economic data that the government uses. And so this is kind of a big deal. This has Wall Street a little bit freaked out. You saw the big sell-off on Friday. It was really revolving around this, and it was also revolving around the Mueller report, which was supposed to drop. Actually, it did drop over the weekend. And so now we're waiting for the leaks to come out from the Mueller report regarding, Donald Trump and all of that we've been hearing about for years. So all of this is kind of coming to a head at once. Economic data has been poor. We've been talking about this now for some time. Both the global and the U.S. economies have been showing signs of weakening at a rather alarming pace. And we're 10 years into this quote-unquote economic recovery, really the slowest we've had in history. And if you look at total government, business, and consumer debt loads, they've reached new all-time highs. So this has really put pressure upon the ability of the monetary policy authorities to be able to normalize policy. And this is why the Federal Reserve has recently kind of made a U-turn. You just go back a few weeks ago, and the Fed was saying, hey, we're going to be raising interest rates at least 2 times in 2019. The economy is robust, blah, blah, blah. And then the stock market, which is not an indicator of the economy, which is not supposed to be something that the Fed is supposed to be looking at according to their mandate, it goes down. And sure enough, that was enough to cause the Fed to begin to suddenly U-turn. And so now the Fed has dropped all pretensions. It's admitting that it has no plan to raise rates whatsoever this year. And in fact, investors now appear to be betting on a return to monetary easing. We've been talking about this now for some time, that the Fed can't go much higher because ultimately the interest rate upon the federal debt is going to far outstrip the federal, for Washington's ability to be able to pay the debt. When you have trillions and trillions of dollars of national debt, and then you have the interest rate rising upon new issuances of that debt, it's just simply astonishing as to what the bill is going to be. We're already seeing the interest payments on the national debt really just taking up a major part of the overall budget. And so, but if you look at the federal funds rate futures over the weekend, we were checking these out over the weekend, and we saw that they were pricing in about a 60% chance that the Fed would lower rates at least once this year. Now, that's up dramatically from just 11% chance 1 month ago. So we've really seen a big shift in expectations, and that's why you're starting to see the gyrations once again, in equity prices. So some have tried to suggest that the economic slowdown is limited to China and Europe, and if it wasn't for that the U.S. would be doing just fine. But America's economy has been clearly slowing for months. This was confirmed by the recent steep revision of U.S. Q4 GDP growth down to just above 2%. This is going to hit the news probably this week, that the overall Q4 numbers that they put out, and they said it was close to 3% or whatever, they're actually revising that down now. So if you look at the Fed, they're already kind of giving us an alarm here. It's indicating they're very, very likely now going to be accommodative as we move into the rest of the year. If you look at the total Fed data about the growth for the economy, we're talking a snail's pace. 2019, they're projecting 2.1%. If you compare that to the Trump budget out for 2019, they're planning on 3.2% growth this year. So they're obviously at odds, a big discrepancy there. The Fed is actually expecting 1.9% GDP growth in 2020, 1.8% growth in 2021. So that's pretty tough. And with this recent yield curve inversion, this is the first time this has happened since 2007. And so, again, it's not surprising to see that investors are a little bit freaked out by it. And right now, if you look at the U.S. corporate earnings right now, they're still expected to expand pretty much overall this year, although they've certainly decelerated. But if you take a look also at stock prices, there's a lot of fear that there's just too overvalued, and I think most of us have felt that way for some time. So that means the stock prices are pretty vulnerable here. So I would not be surprised whatsoever to see more weakness as we move in to the new week. Another headline here, February marks the largest monthly U.S. budget deficit ever. Unbelievable news here that the U.S. has just posted its biggest monthly budget deficit on record in February. And again, total crickets. Debts, deficits, and denial about economic reality continues to be the way forward in 21st century America. Somehow, we believe we're going to grow our way out of this debt, and our growth rate's about, 2%? So how are we going to grow ourselves out of this? We're not. We're going to have to pay it. And that's the big joke, or that's the big punchline that nobody seems to be realizing. So February marking the largest monthly U.S. deficit on record. We have never had a monthly U.S. budget deficit ever on this magnitude. Welcome to 2019. Also, another big headline this week, or last week, Italy turns east as China courts a divided Europe. Italy became the first G7 country to sign on to China's ambitious Belt and Road Initiative. This is a big coup for China, which has really been trying to garner support from Europe. Europe is still divided, but President Xi is going to be meeting with Macron from France, also Angela Merkel from Germany in the coming days, and there's more deals that are likely to be revealed. And Washington is nervously watching this because they have tried to shoot China in the back. They've tried to prevent China's rise. Instead of just dealing with it, instead of trying to cope with it and actually come up with better measures, they're trying to stop it. And we've been pointing out that this is just a bad move forward, not a smart way to proceed. But big news, you can click on the links here. BBC has this report, and it's just quite stunning. And so will be more headlines coming out about this, no doubt, as China continues to court Europe this week. Another big news item here for those of you who are invested in the cannabis space, CVS Pharmacy announcing last week that it's going to begin selling hemp-derived CBD products in 8 states that they're listed right here, as you can see. So big deal here. As we're starting to see the mainstreaming of cannabis. And we've been talking about this now for some time. It's these kinds of headlines that are changing the whole discussion, changing the whole dialogue on this topic. Now, the DEA and the FDA are desperately trying to protect their buddies, the good old boy system that they've built with the big pharma, and they're trying to prevent this. They're telling CVS not to do it. They're trying to warn. They're telling them they're not giving them, permission or whatever. But CVS apparently just doesn't care. They're moving according to the free market, and they're moving straight forward because it is legal, despite the fact that the FDA, prefers us to take big pharma pills. Natural remedies are continuing to flourish. And CVS, good for them for leading the way forward with CBD products. Again, by the way, CBD products, for those of you who are not familiar, are not psychoactive. You're not going to get high if you ingest or use a topical CBD product. It's the non-psychoactive part of cannabis plant, the hemp plant, and so which are kind of connected. So regardless, big news there, even for those of you who are interested in the CBD space. That's really big news. The company that's benefiting from this particular deal is a company named Medterra, and we'll talk maybe more about that on our upcoming Tuesday coaching call. By the way, we still have a very great special on our cannabis report. It's only $37. We're giving you a master class video, about 90 minutes, on how to profit from the global cannabis boom. We put a lot of research into this, and we think there's going to be a lot of more upside ahead. We've already had big upside so far this year. We think there's more coming. It's not going to go straight up, but getting a position now, getting a long-term position now is probably could be a smart idea for some of you. So if you're interested in that at all, go to followthemoney.com/cannabis, and you can learn more about that particular report. We didn't have any uptrends this week. In our PACE portfolio, we had nothing going on there at all. No new uptrend alerts, and neither any new downtrend alerts, although we will say that anybody who was following our uptrend alert on MJ, which is the Cannabis Hemp ETF, back on January 11th, we called a new uptrend on it at around $31. And since that time, it's soared. It actually went up about 26% in just about 2 months. And we would recommend taking at least half of the gains here. Anytime a position rises 20%, it's always wise just to take that money off the table or raise stops, to a place where you lock in that gain. But here it just makes sense to take some money off of the table. It looks a little overstretched. We're at some resistance areas here. And then maybe, taking half off the table, selling it, and then letting the other half ride with a tightened stop loss. But again, we would be selling half of any shares of MJ on Monday, and then with a 34.48 stop loss on the remaining half of shares. That's how we would proceed. Again, no new uptrends on the global side, but we did bring Turkey out of the portfolio. We deleted it. Since our uptrend alert on that back in January, we had, about an 8.4% rally in that one. So it certainly got us, a nice, decent rally there on Turkey. And then also we pulled the 3D printing ETF out of the Trailblazer ETF portfolio. That one earned about 6% in about a month back in February after we called it. But it's certainly falling now, so it's out of the portfolio. I got a little bit of detail here about our upcoming summit. Most of you are very familiar with that now. If you want to reserve your seats, or if you haven't done that already, you can go to summit.followthemoney.com. And we also have our trend trading boot camp coming up as well. Very excited about that. The S&P 500 index still remains in a position uptrend, but the long-term trend still under pressure, still just not doing anything at all. It's not. It has not given us a new uptrend at all. It's kind of still unconfirmed. And so there's a little bit of commentary here. If you click on this keep reading button here, you can read our full commentary on the S&P 500 and the market in general for last week and what we see going forward. The S&P 500 here closing right around 2,800, right at the area of great support. And this is an area where we're going to be watching closely. If we break down below the 200-day moving average, as we did earlier this month, then we could have, more downside ahead, especially that 50-day moving average, which is rising. I think you're going to see a lot of people paying close attention to that right now, about 27.34. So just use caution. We got rising volume here as the market is starting to pull back amid some of this scare about the overall global economic slowdown. Treasuries, by the way, the Treasury yields in free fall. You can see here's the 10-year yield. This collapse in the 10-year yield was due to the fact that people are piling into bonds, right? And so when you have more demand for bonds, then the yields for them go down. And so that's what we're seeing. And that's why that 10-year yield fell, and it fell right below the 3-month yield. So this is all we needed. We just needed this final impetus to push us down and create that inverted yield curve. Take a look at the 30-year Treasury yield as well. You can see this thing is fully in a multi-year bearish channel. It just continues down as more money is pouring into bonds. Dow Jones also suffering some sell-off over the week. And again, watch out right here at that 50 and 200-day support right around 25,200, somewhere right in there. You want to be watching that area. We got some creeping volume here on the sell side. Also in the NASDAQ, right back at support, 7640, which is coinciding with that 14-day EMA. Again, watch the 250-day here. These are going to be the key areas that if these break down, then you can expect much more downside, potentially much more downside ahead. Gold still trucking right along. I mean, you can see here clearly that we've got a nice, general uptrend going on here with this rally. So it's just continuing to zigzag back and forth, kind of moving right along, humming right along. And so we do have more upside, we believe. Watch out for 1350 on the upside, maybe all the way up to 1380. And then you have 1280 support, very, very strong on the bottom here. So we would expect that to hold, especially in this current environment. Also with silver, $15 support, really holding strong as of late. And we'll just continue to watch silver, which also is still continuing to uptrend. Utilities, I mean, when you think about the overall economy and you think about, how this is supposedly the greatest economy ever, the fact that utilities are leading the rally, within our sector rotation strategy just speaks volumes. I mean, utilities are not, they're not the kind of sector you want to see leading a historic rally. I mean, it tells you there's something wrong, and it tells you there's a lot of defense going on. And so surely this is a sign of defensive investing. I mean, on Friday, utilities picked up. As you can see, they actually gained on the day as the market was selling off pretty sharply because people are looking for a defensive posture in this environment. So the fact that utilities continue to lead, almost have just been going straight up since December, tells you what kind of rally this really is. And it's not just the long-term sector that utilities is leading in. It's also leading in the position trend. So it's really quite something. And then also real estate as well. It's ranked number 2 across the board, both long-term and position. Real estate also, not surprising that we saw money just pouring into real estate, also pouring into REITs, because the Fed has all of a sudden said it's not going to be raising rates. And in that kind of environment, people look for yield, and REITs are one of the top ways to get yield in this current economy. And so REITs are very popular. Real estate provides income. And so it's not surprising to see people piling, or investors piling, into real estate stocks as well, amid a fear that we're going to see either static or stagnant rates, or very likely declining rates, which makes higher yielding stocks like utility stocks and real estate stocks just much more attractive. I strongly encourage you, if you haven't been on to followthemoney.com/SmartScore. I've left this ad in here for a little bit because I really want you to see this. This is a really helpful page that shows you different areas. You have the U.S., China, Canada, mining, MLPs, REITs, all based upon our proprietary SmartScore ranking. So you can go in there and see, what stocks are leading the way forward. Every single week we update that. So it's a nice way for you to see, what's going on around the globe and look for those kinds of stocks that you might want to trade. It's a helpful resource for research. Turning to stocks to watch here, Kronos Group is going to be reporting next week. We'll look at some of the other stocks that are going to be reporting this week. Kronos, has that big deal with Altria, and we'll see. We'll see what is going to happen here with Kronos. We expect some big movement in the stock when they report earnings. The stock, at one point was up more than 100% in 2019. So far this year, I mean, it opened the year around $10. And then it's just run all the way up to 24, and then now it's back down to about 19. So we're up about 90% right now. Realistically, if we get poor earnings, or if the market just gets super scared, you could see this stock fall back to the $12 to $14 range. If that's the case, we'll probably be buying with both hands, because this is a longer term hold for us. So we'll be watching Kronos, looking for a pullback, though. It certainly has. We've sold a lot of our shares. We still have a core position in the stock, but we're really, really light on the shares that we own compared to where we were at the beginning of the year when we were riding this big rally. So we're light holding in our holding right now. We're looking to add, but we need an impetus. We need something, and right now we've been really tight on the price action. Maybe we'll get a nice sell-off, and that'll attract us back into the stock. We'll be watching Kronos, C-R-O-N, this week. We'll also be watching Ollie's Bargain Outlet, one of our favorite stocks to trade. Kind of been in a bearish mode here lately, along with some other retailers that have kind of had a tough time. But you'll see here the stock has been consolidating in the $78 to $80 range right in here. And you can take a look at the EPS. EPS growth has been real solid. Sales growth has been real solid as well. But who knows? With this current market the way that it is, we'll see what happens to Ollie's, O-L-L-I. It's solid $75 support. If it breaks down below that, could go much lower. So just be careful around that area, around 75. That might be the area for support here. But we might get a nice pop on earnings. We'll see what happens. We'll be watching Ollie's this week. And also one more that we haven't talked about too much, but one that just keeps coming up on my radar over and over again when I do scans, and I'm looking for stocks that are meeting, many of the fundamental criteria that we like. Cons. I mean, I never really have thought about, much about this particular company. It's a retailer. Maybe you're familiar with Cons. You maybe have seen them. They're a specialty furniture and electronics retailer. They were able to finally stop the bleeding in their EPS. Take a look here. Back in 2014, 2015, 2016, they were just going down in earnings. They finally bottomed in 2017 and then started to return to profitability in 2018. They got this new strategy going, and I've been kind of following the stock lately, and it's really bottomed out here, right down here about 18, 17, 16, somewhere in here. And it's starting to curl back up. So I'm watching this one. This will really be a key moment here for their earnings to see whether this strategy is going to continue paying off. Watch for a breakout above $25 on Cons, C-O-N-N. We'll be watching that one as well this week. Some other earnings we're watching this week. Winnebago, we like the RV space. It's kind of a demographics play, not just on the silver tsunami, as you will, with all of the retirees, but also, younger people as well. So Winnebago, we're watching. Also, Kronos Group, as we already mentioned, that's going to be Tuesday before the open. Carnival Cruise Lines, that's just kind of an interesting one to watch. It kind of tells you the demand for these kinds of luxury, products. Certainly a consumer discretionary stock. Cons, again, reporting Tuesday before the open. There's Ollie's on Tuesday after the close. Shoe Carnival, fast-growing shoe retailer that might have some interesting info about, just where retail is right now. I might be watching that one as well. Five Below on Wednesday after the close, also Lululemon. That one, it seems to be a real hot stock. It often finds itself in the IBD 50, as does Five Below. These probably are worth watching this week. CarMax, another kind of interesting stock as well, we'll be watching. There's a few other ones going on, but these will be the ones we'll be paying close attention to. And that really brings us to the end. I also want to let you know that new podcast, Are You Ready for the Green Gold Rush? If you haven't listened to that yet, I highly encourage it. We talk about some of the stuff that has to do with the global cannabis boom. Really quite an interesting industry there. But that brings us to the end. Thanks for tuning in for this Robinson Report video version. I hope you have a wonderful rest of your weekend, and God bless you. We'll see all of our gold members and platinum members on Tuesday for our live private group coaching call. We'll be taking your questions. God bless.